As students, we all want to know how to do better for our examinations. What is the best way to spend our time and energy to achieve the best results? Report slips tell us our performance for the year and the areas for improvement. Therefore, it helps us develop better strategies to improve our results. It is the same for businesses. The income statement is the business's report slip for the past year. It tells us the business performance for the year and the areas for improvement. Therefore, it helps businesses to develop better strategies to improve its performance. Let's see how Daniel Bookstore uses information from an income statement to calculate the gross profit margin and markup on cost. If Daniel buys a book for $8 and he sells it for $10, the gross profit is $2. When we take gross profit divided by the sales price, we will get gross profit margin of 20%. This percentage tells us the ability of the business to earn gross profit by selling its products. The higher, the better. If we take gross profit and divide it by the cost price, we will get markup on cost of 25%. This percentage tells us the ability of the business to charge a higher sales price or buy its goods at a lower cost price. The higher, the better. However, a big business like Daniel Bookstore would want to find out the gross profit margin and markup on cost for all its products. He will need to make use of the numbers from his income statement. Based on its income statement in 2017, the gross profit margin is 16.7%, and the markup on cost is 20%. Other than maximizing gross profit, managing expenses is another key factor to improve profitability. Businesses calculate the percentage of expenses to net sales revenue. This percentage tells us whether they have been efficient in spending their money to earn net sales revenue. Based on its income statement in 2017, its percentage of expenses to net sales revenue is 22.8%. The lower, the better. So, how do we measure the overall performance of a business? We use the ratio called profit margin. This is different from the gross profit margin because gross profit margin looks only at the buying and selling of goods, while profit margin looks at the operation of the whole business. Based on its income statement in 2017, its profit margin is 5%. The higher, the better. After we have calculated the profit margin, Daniel wants to know if his business makes enough profit for the average amount he has invested for the year. To know whether Daniel Bookstore has earned enough profit for Daniel, we will calculate the return on equity ratio. To calculate the return on equity, we take the profit for the year divided by the average owner's equity. The average owner's equity is calculated by dividing the total of beginning owner's equity and ending owner's equity by 2. Based on the balance sheet, the return on equity is 18%. The higher, the better. In conclusion, we have looked at 5 ratios that measures the profitability of Daniel Bookstore. Even though a business's performance is important, we also need to consider the health of the business. Similarly, as a student, we want to do well for our studies without sacrificing our health. In the next video, we will use the liquidity ratios to find out the health of a business. How do you know how healthy you are? What do doctors ask when you go for a health check? What information do they need? For a business, its health is measured through the liquidity ratios. When the business is able to pay its short-term debts using current assets, the business is liquid. Even if it is profitable, it may still go bankrupt when it is not liquid for a long time. Hence, it is important to be profitable and liquid. We will now calculate 2 liquidity ratios using the information from the balance sheet of Daniel Bookstore. First, to calculate the current ratio, we will divide the total current assets by the total current liabilities. This ratio is expressed as 2.20 to 1 instead of a percentage. This tells us that the total current assets is 2.20 times the amount of total current liabilities. The higher, the more liquid. Next, we will look at the quick ratio. Do you know what quick assets are? Quick assets are current assets that can be converted into cash quickly. They are cash and receivables. What about inventory and prepaid expenses? No, they are not quick assets because they cannot be converted into cash quickly. To calculate the quick ratio, we will divide the total quick assets by the total current liabilities. This ratio is expressed as 1.21 is to 1 instead of a percentage. This ratio tells us that the quick assets is 1.21 times the amount of total current liabilities. The higher, the more liquid. Is it always good for a business to have high liquidity ratios? No. If a business has too high a liquidity ratio, it means that it is holding too much cash, which could be used to improve its profitability. For example, the additional cash can be used to buy a new machine to improve its productivity. In general, a current ratio of 2 to 1 and a quick ratio of 1 to 1 is a norm. In this lesson, we have calculated the current ratio and quick ratio to check whether a business is liquid. It is important to be profitable and liquid. In the next lesson, we will look at another ratio to see how well a business manages its inventory. Welcome to the warehouse of Daniel Bookstore, where we store the books that the business buys and sells. When we buy books from suppliers, all its related costs are classified as inventory. When we sell books to customers, the related costs are transferred to cost of sales. Why is it important to maintain just enough inventory in the warehouse? We will lose sales if we have nothing to sell. We will pay more for storage cost if we have too much inventory in the warehouse. To see if a business is managing its inventory efficiently, we calculate the inventory turnover rate. If Daniel Bookstore sells $10,000 worth of books during the year, and it holds $1,000 worth of goods in its warehouse on average each month, then the inventory turnover rate is 10 times. This tells us that the amount of goods sold is 10 times the amount of goods not sold. That is, goods have been bought and sold 10 times during the year. Inventory turnover rate is calculated by dividing cost of sales by the average inventory, and the average inventory is calculated by dividing the sum of the beginning inventory and ending inventory by 2. Is it always good for a business to have high inventory turnover rate? We cannot say for sure, as it depends on the nature of the business. However, in general, if the rate is too high, it means that the business is buying small amounts of goods too often. Hence, it may incur more delivery costs and enjoy lower trade discounts. If the rate is too low, it means that the business is buying large amounts of goods each time it orders. Hence, it may need to keep the goods in the warehouse for a longer time and incur more storage costs. Ideally, a business should have enough goods to meet the demands of its customers so that costs can be as low as possible.